The Federal Reserve hikes rates by 25 basis points. Chairman Powell indicates that hikes may be coming to an end, but rate cuts remain off the table in 2023 as the fight against inflation continues. Treasury yields drop and stocks slow sharply lower, led by regional banks, which slumped on Treasury Secretary Janet Yellen's comments on insuring bank deposits.
We believe, however, that events in the banking system over the past 2 weeks are likely to result in tighter credit conditions for households and businesses, which would in turn affect economic outcomes. It is too soon to determine the extent of these effects.
Fed Chairman Jerome Powell reaffirms his confidence in the banking system, but says that recent failure of some regional banks could cause ripple effects that could slow down the economy. Also assures Americans that the Fed has the tools to keep depositors' money safe, while Treasury Secretary Janet Yellen rules out blanket insurance for bank deposits. Stocks in the Asia-Pacific opened weak but come off lows as investors digest the U.S. Fed's rate hike. The SGX Nifty 2 is indicating a weak start for the Indian market. Crude prices continue to rally off 15-month lows. Brent gains about 2% to over $76 a barrel as the dollar weakens after the Fed rate hike. The government launches an offer for sale in Hindustan Aeronautics for a maximum of 3.5% stake. The offer, priced at 2,450 rupees a share, is at a 6.6% discount to yesterday's closing price. Good morning in the Mumbai News Center. I'm Sonal Bhutra and you're watching Power Breakfast. Those were the top headlines and some big ones. At that, we got the Fed commentary, the Fed rate hike at 25 basis points, and that is something which impacted markets globally. So let's do that and take a look at what the Asian markets are doing right now. We saw U.S. markets, closing lower in yesterday's trading session. Asian markets also were lower, but some of them have recovered. For instance, Hang Seng is the one which is up 67 points as we speak. The Taiwanese index, though, is down. It's absolutely flat with some negative bias right now. It's actually only Hang Seng which is in the green as far as the Asian markets are concerned. Shanghai is down around 3 points. We have Kospi, which is lower by 8 points. Nikkei 2 is down by 121 points. So the losses are the leading indicator here is Nikkei, which is down 120 points. But apart from that, most of the indices are absolutely flat right now. SGX Nifty right now is indicating that the start for our own markets, well, that could be in the red. It's a 50-point downtick that the index is suggesting at that 17,106 mark. But of course, to the big Q this morning, the U.S. Federal Reserve hiked rates by 25 basis points. This is the 9th hike since March 2022. The Fed expressed caution about the recent banking crisis and indicated that hikes are nearing an end. CNBC's Steve Leesman gets us the highlights. Steve?
The Federal Reserve raising by 1/4 point, by 25 basis points to a new range of 4.75 to 5%. It is the 9th hike in a row since the Fed began hiking in May 2022. The Fed providing some guidance saying additional policy firming may be appropriate. And that's perhaps a bit of a downgrade from what they said last time, where they said ongoing increases in the policy rate may be appropriate. Now they're saying additional firming. We'll have to talk what that means. Now, they said recent developments, which seems like a euphemism perhaps for the recent turmoil in the bank market. They said recent developments are likely to result in tighter credit conditions for households and businesses. Those tighter credit conditions will weigh on economic activity, hiring, and inflation. The extent of these effects, however, is uncertain. Now, they left unchanged their year-end projection for the funds rate at 5.13%, which suggests they believe they'll be hiking at least 1 more quarter point and then be done. They raised next year's funds rate projection to 4.3%, which you'll notice is below the projection for the year-end. So there are some cuts built in by the Fed next year, but a little bit less than there had been before. They forecast a bit more inflation this year at 3.6 versus 3.5 for the core PCE. They said inflation remains elevated. Remember last time they said it had eased somewhat. That was gone from this particular statement. They said the U.S. banking system remains sound and resilient. On the economy, modest growth in spending and production, they've noted. Job gains have picked up and running at a robust pace. Guys, the one thing I'll notice from this thing is first the change in language for some additional firming may be appropriate. The other thing is almost no connection at all from their comments about the impact of tighter credit to the effects on the economy with policy, except for that little squishy language about what happens next.
Inflation remains well above our longer-run goal of 2%. In February, the 12-month change in the CPI came in at 6%, and the change in the core CPI was 5.5%. Inflation has moderated somewhat since the middle of last year, but the strength of these recent readings indicates that inflation pressures continue to run high. The process of getting inflation back down to 2% has a long way to go and is likely to be bumpy. We published an SEP today, as you will have seen, and it shows that basically participants expect relatively slow growth, a gradual rebalancing of supply and demand in the labor market, with inflation moving down gradually. In that most likely case, if that happens, participants don't see rate cuts this year. They just don't. I would just say, as always, the path of the economy is uncertain, and policy is going to reflect what actually happens rather than what we write down in the SEP. But that's not our baseline expectation.
Okay, that's the word coming in from Fed Chair Jerome Powell. Let's listen into some reactions to the Fed's rate hike coming in from David Zorvos, who's the chief market strategist at Jefferies.
This 2 weeks has introduced a lot of uncertainty to the Fed, to the markets, to everybody involved as to how much of a pullback there will be in the credit provision process. The Fed sees a sting coming, and I think they want a sting to come. They want that mild recession. They'd love a soft landing. They take a soft recession, and they want inflation heading back to 2.
And following the decision in Fed Chair Jerome Powell's press conference, Wall Street ended the day lower, with the Dow Jones sliding over 500 points, and both the S&P 500 and the Nasdaq Composite closed over 1.5% lower. Market also came under pressure after U.S. Treasury Secretary Janet Yellen said that the FDIC was not considering a blanket insurance for deposits, while Fed Chair Powell said events in the banking system are likely to result in tighter credit conditions. Listen in.
Our banking system is sound and resilient, with strong capital and liquidity. We will continue to closely monitor conditions in the banking system and are prepared to use all of our tools as needed to keep it safe and sound. In addition, we are committed to learning the lessons from this episode and to work to prevent events like this from happening again. We believe, however, that events in the banking system over the past 2 weeks are likely to result in tighter credit conditions for households and businesses, which would in turn affect economic outcomes. It is too soon to determine the extent of these effects, and therefore too soon to tell how monetary policy should respond.
This is not something that we have looked at. It's not something that we're considering.
Dan,
I have not considered or discussed anything having to do with blanket insurance or guarantees of all deposits.
Okay, some important comments there, but we'll keep discussing that in further detail. We'll slip into a short break now, and up next we'll tell you how these global cues could impact our own market. Stay tuned for that. Welcome back. You're watching Power Breakfast on CNBC-TV18, and this is our Power Prep segment. We have our research team joining in with what the trade setup looks like, the stocks that are likely to be in the news, and the action from the F&O space as well. Hey guys, a very good morning to all of you. First up, Rima, let me come across to you. So the big event is something that we have seen already. What is the market setup looking like today?
Well, this morning we've seen the Asian markets follow the US markets lower. So currently there is red on the screen, and the SGX Nifty is suggesting that Indian markets will have a gap up opening. A bit of a disappointing session out on Wall Street, as you pointed out. At one point of time, Dow was up 200 points, but it ended down 500 points. Two key reasons for that. One, the street was hoping that the Fed would give indications that it's likely to pivot towards the end of the year. That's not happened. So the Federal Reserve, in a way, pushed back against bets of interest rate cuts this year by maintaining its focus remains on inflation. And two, Janet Yellen also indicated that it's not considering a blanket deposit insurance to stabilize the banking systems. So these were the two sore points yesterday, and that led the disappointment on the equity markets. Today for the Indian markets, we have the weekly options expiry. Yesterday, volumes were on the lower side because traders were on a wait-and-watch approach, and we had the goodie part of our holiday. The DIs bought 383 crore in the cash market. The FIs net bought 61 crore in the cash market. As I said, today is the weekly options expiry. There will be a bit of a gap down opening to begin with. The big support for our markets continues to remain Monday's low level of 16,828. On the way up, it will be levels of 17,200, 17,250, which the bulls would like to conquer before heading up and seeing upward momentum. Back to you.
Okay, all right. Thank you so much, Reema, for all those cues. So that will be in focus today. Over to Abhishek now. He'll list out the stocks which will be in focus today.
Well, to begin with, GR Infra Projects, they are L1 bidder for tender invited by NHPC. Total project cost is about 3,637 crores, and GR Infra has a 50% stake over there. And 86 months is the timeline to complete the project. NBCC, construction of medical college in Jalgaon on EPC basis, total values around 625 crores. HG Infra, they are L1 bidder for NHAI project. The cost is about 925 crores. The timeline given is 730 days. Nazara Tech, a subsidiary, acquires a pro football network. Total cost is about 16 odd crores for 73.3% stake. Coromandel, they have announced entry into specialty and industrial chemicals. They will invest 1,000 crores over the next 2 years. Hero MotoCorp, there is a price hike of around 2% on select motorcycles and scooters effective 1st April 2023. Chalet Hotels, they have approved a share purchase of 100% in Solmin Industries for around 75 crore and about 82.3% in Duke's retreat. And last but not the least, HAL government launches OFS to sell up to 3.5% stake, a total size of about 2,870 crores. Floor price is at 2,450 per share, which is a discount of 6.6% to the CMP. Back to you.
Okay, all right. Those are all the stocks that are in focus. Let me finally go across to Nigel, who's joining in with all the cues from the F&O space. Hey, Nigel.
Well, morning, Sonali. Yesterday we were talking about lower participation coming from the domestic, participants out here. Well, if you look at the F&O market, there was a fair bit of lightening of positions as well ahead of the big events. There was unwinding both on the Nifty as well as on the Nifty Bank, as the open interest suggests. What do the FIs do? Well, not too much on the index futures. Remember, they continue to remain net short, with the net short positioning at around 92% odd, but no big change out there. The options that were bought as well, there was some unwinding out there. But what is encouraging is, and what's giving some bit of hope is, there was put writing yet again. Close to 19,000 contracts were written in trade yesterday. So to pull up a couple of strikes, the 17,150 put, well, out there added close to around 20 lakh shares. The premium out there is around 70 rupees. On an average, it would be around 80 to 90 rupees for the day itself. So that's the crucial mark out there. And on the Nifty Bank, well, the 40,000 putters, well, added close to around 15 lakh shares. So there was some writing out there. Maybe the average for the day was close to around 300 to around 400 rupees odd, which brings us to the level. Since there was some writing added on the 17,100, 17,150 put, well, you're looking at the 17,050, 17,050, that becomes a crucial support zone. We're not talking about higher levels since we're going to start off well in the red. But, at high level, 17,250 to 17,300 is a bit of a resistance zone. The Nifty Bank, that's going to be very, very important. You need the Nifty Bank to hold on to the 200 DMA or somewhere close to that. You don't want it to break the 39,500 mark decisively. So that's crucial on the downside, while the 20 DMA becomes a bit of a resistance on the upside. SGX Nifty suggests a pullback. Positioning is such today that on weekly expiry, the bulls will like to protect the 17,050 odd mark. Let's see how it goes.
Okay, all right, Nigel, thank you so much for joining us with all those cues. This is our Power Rec segment. Thank you guys for joining us. For that, we'll slip into a short break now. We'll get you all the cues from the commodities market when we come back from the short break. Stay tuned. Welcome back. You're still tuned into Power Breakfast on CNBC-TV18. Let's talk commodities now. Manisha Gupta is joining us with all the update from the commodities space this morning. Hey, Manisha, good morning.
Morning, Sonal, for that. Well, we are looking at volatility continuing for many of these commodity prices. Well, the benefit has been there from the Fed's cautious stance, but the markets still are concerned about the inflation that the U.S. Fed talked about. So if you look at the crude oil prices, while we did hit $76 a barrel on the higher side, we've seen the prices not being able to hit that or hold that. And even then, we are trading 4% on the higher side for the crude oil prices in this week. Markets also are looking at the U.S. inventories showing a further build-up, but it is a Chinese demand that is keeping the prices where they are right now. In the metal sector, gold gained 1% overnight. Silver was up 2%. Copper prices gained up for a fifth straight session by 1.5% on the higher side as well. Here as well, the decline in dollar index now below 102 seems to be supporting the market. For metal prices, essentially, it is from China where the data has been slightly stronger. We've seen on-spot demand higher. So the cash premium has been higher than what the 3 month is trading at. So that tells you that on-ground demand seems to be picking up. So most of the metal prices, whether it's copper, aluminum, steel, have seen gains come in the overnight space.
Okay, all right. So that's all the update from commodities. Manisha, thank you so much for joining us with that. With that, we'll take your leave on this edition of Power Breakfast. Do stay tuned. Bazaar Morning Call takes up all the action ahead.